to build on what we saw yesterday with a little bit of positivity, at least in the tech space, not so much everywhere else, just really fading as the session grows older. NASDAQ futures up 0.2%. Russell 2000 also up almost the same amount. Curious, given what we're seeing in the bond space, 2s, 10s, and 30s, yields climbing at the longer end of the yield curve, not because of CPI yesterday, but because of what we saw from the Bank of Japan, hiking rates to the highest levels going back 30 years. 30-year yields rising in sympathy, 4.83%. Really have been pinned there. Danny, to me, this is really the story. They've been pegged at this higher level, and people saying it's okay because ultimately the economy is strong enough to look past this.
Right. It's been trading in a really tight range too, in that same level. So maybe that's why it's like, okay, maybe the level isn't great, but the direction is not concerning. But then you also have volatility trading really low. How much of that though does get disrupted from what we're seeing globally? And that is the story of this morning, and likely it's going to be the story of 2026, with Bank of Japan, BOE, and ECB signaling that either they're hiking in the case of Japan or that their rate cutting cycle is over.
Yeah, the global story also very much front and focus for corporations. 1 hour away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. The housing market continues to challenge the home builders. We saw that with Lennar earlier this week, and now with KB Homes. Shares are falling 4.25% after they delivered fewer homes than expected, while profit also weakened in the last quarter. That's thanks to those big incentives that they've been offering buyers to get them in their homes. KB Homes also issuing a weaker outlook than expected as those challenges around affordability and mortgage rates look set to remain. Meanwhile, we are seeing Oracle shares rising nearly 4.6% in the pre-market on a reporting that it will be part of an American consortium of investors set to take over TikTok's U.S. operations. Oracle would gain 15% ownership under the deal, which analysts are saying would lock in TikTok as a major cloud customer for Oracle. This is all according to a memo seen by Bloomberg, with the deal expected to close on January 22nd. And we end on Nike, big mover to the downside, down now 11.6% after the company warned that sales will drop this quarter, and that's thanks to two major issues. It's China sales and its Converse brand. The weakness surprising investors after 2 straight quarters from Nike of growth. The negativity also spilling into the broader footwear sector, with Deckers, which makes the UGG, and Hoka shoe brands also falling down 3% in the pre-market. Lisa?
Thank you so much, Yahaira. Meanwhile, Wall Street casting doubt in November's CPI report, hitting a 4-year low after several categories with previously stubborn inflation appeared to nearly evaporate. Bloomberg's Michael McKee joins us now. Mike, what's the latest when people parse through this, particularly with respect to owner's equivalent rent?
Basically, you just have to look past this, and that's what most people are going to do. Nobody thinks that BLS did anything wrong, illegal, put it that way, or conspiratorial, but they did have a statistical issue with how you deal with the fact that there were no October data. And so what they did was just move September data into the October boxes, and that ended up meaning that there was, for housing, zero change in prices, which is not likely at all. So everybody's looking past this, and we'll get the December CPI numbers in January, and that'll be much more dispositive as far as what the Fed's going to do.
Thank you so much, Michael McKee, and we'll be looking forward to that data with possibly more clarity. Alicia Levine, head of investment strategy and equities at BNY Mellon, still with us. I'm just curious what your takeaway was from the CPI report we got yesterday.
Well, of course, there was that first shock, like, wow, it's much lower. But then it became clear that there are donut holes there. So I think overall, better that that inflation report was weaker than stronger, and really good that we don't have to debate whether or not the higher readings are real or not. But I think ultimately the market told you yesterday, the bond market told you yesterday, that we understand that this data is not quite firm enough, and we'll have to wait and see. I think overall the last 2-3 months and all the data reads, the comparisons have been very hard, the collections have been difficult. So the Fed is working in a little bit of a data vacuum still, because it's very hard to have a month-over-month read when you're not quite sure if the collection was the same as it was historically.
How much does inflation boost the case for equities? beyond the case of fixed income, beyond the case of almost any other asset class?
So I think you really have to separate it here, because clearly inflation reads for fixed income are quite difficult, and small changes can matter a lot in market pricing and in portfolios. On the equity market, it's a very different thing because earnings are nominal, meaning it takes into account inflation. And so any bit of inflation that does not cause a Fed pivot, right? The key here is the Fed pivot. And the pivot meaning from a cut or a hold to a hike. So as long as inflation is somewhere in that place where the Fed is not pivoting, then it's actually fine for equities, and that inflationary piece gets reflected in market pricing because it gets reflected in earnings. So very different in your asset classes, which asset classes can handle a little bit of extra inflation and which not.
Yeah, and the idea of a hike right now, very much not on the Fed's picture.
And of course, that would be a risk.
That would be a risk.
That would be a risk.
But right now, doesn't seem to be in anybody's bingo card for next year. Ryan Wong of HSBC joins us now to parse through what we have heard. Ryan, do you think it is appropriate to just look through yesterday's CPI report?
Well, I'm not sure we can just entirely look through that release. Now, it's true that the most analyzed portion of that report did relate to the rental inflation, and I do think it's fair to say that the number itself was likely distorted on the rental side. But we still have to build a new fact pattern for what rents will look like as we go into next year, because actually there had been some evidence even prior to yesterday's report that rental inflation has been slowing gradually. So I don't think we can entirely dismiss it. And then, yes, if we look at the other components of the report, they also surprised the downside. Maybe there were some seasonal distortions. Of course, we are, going into the holiday season, so therefore the timing of when that data collection happened might have led to some of that downward distortion.
How are you thinking more generally, Ryan, about the data and the quality of data itself, whether it's good enough to make decisions by the Fed, or whether this is a Fed that is in hold not just because of the pressure from the dual mandates, but because of the lack of clarity from the numbers themselves?
Well, I think in the United States, the one thing is we do have